Thank you, everyone, for joining us today. My name is Autumn Sullivan. I'm the marketing director at Mobilization Funding, and I'm so excited to bring you these three cash flow experts. We're going to talk about cash flow management in construction. I have Scott Peper, the CEO of Mobilization Funding. I have Lori Drake, who is the community manager of payment professionals from Levelset, and Suzanne Cox, who is a partner at Saltmarsh, Cleveland Gund. And Scott will be leading the conversation. They have a list of topics, but if you have a specific question you want to ask, please drop it in the Q&A and I will make sure they get that. And without further ado, I'm going to go behind the curtain, hide my screen, and monitor our LinkedIn conversations and our chats. You guys have a great conversation.
Thank you very much, Autumn, and welcome everybody. Lori and Suzanne, I really appreciate you guys joining me and going through this topic. I know the three of us are very impassioned by cash flow, specifically for construction, how people get paid, when they get paid, how we can make it better, how we can fix it. And I think each of us have a shared perspective, but also comes from different ends of that cash flow waterfall spectrum. So I find it really interesting and exciting to be able to go through that with you guys and kind of, I think the genesis of how we all landed on this spot together from where we came from with these clients, I think is going to be really impactful and beneficial to the collective audience. So jumping right into it, first and foremost, thank you for joining me.
I'm glad to be here. Thank you.
All right, jumping into it, I want to talk about basically the flow of cash in and out of a construction business and how it's a little bit different than many other industries' cash flows. And what I mean by that is every business has, I like to call a revenue cycle. You get an order to do work today, and ultimately you either perform that work, you make a product or a service, and then you invoice it and you get paid. To me, that's the revenue cycle. And then there's cash needs all along the way, just for that specific opportunity of revenue. And then that has to marry up to the cash flow needs of your overall business. But specific to construction, there's some unique things about that that are very different than other industries. And so, Suzanne, can you share what experience has been like working with contractors in your role as a CPA and what you do to help manage contractors' cash flow? And I might have a follow-up question or two after that.
Sure. So I'm making a wild assumption that we have some contractors on the phone here. So you guys probably already know why cash flow is a challenge. So I won't back up and talk about why, but obviously there's this time period between, when you may have mobilization costs and you've got labor costs and supply costs and all of these costs, and they're rolling in the door and you may not get paid for 60 to 90 days, depending on who your customers are. So you've got this very long wait time in between when the services are performed and when you get paid, unlike, say, a restaurant who also has the same thing, supplies, people, et cetera, but the minute you give that service, you're getting paid. There's no 90-day wait time to pay for your meal that you just had, so there's obviously a huge challenge in that. I would say that I have some contractors that have desperate cash flow needs, and then I've got contractors that are sitting pretty nice. And it depends. I'll tell you on a few things, what kind of construction they do, who they work for, who their customers are. If they're working for the government, perhaps they're getting paid really timely and they're submitting on line and they get paid in EFT in a couple of days, but that's not going to be most of your contractors out there. So it does depend on what type of construction you're in, who your clients are, how well you manage your business. And I'm not sure if you asked me part of that, but my contractors that are paying close attention to cash flow, they've got a dashboard. They're constantly monitoring what their AR turnover is, and what that means is how quickly they get paid. So they send a bill, and that time in between when they send that bill and when they collect the cash is essentially a turnover rate. And so the people that are monitoring their collections and their turnover very closely, and they're monitoring their payables, how soon they're paying people, and can they negotiate better terms, both on the front side and the back side. The contractors that are very focused on those are obviously usually in a better, cash position, the ones that are just winging it. And I say that because a lot of people do, when times are good and there's a lot of work, some of these like accounting, boring accounting details, they tend to get pushed to the back burner. And so the contractor is, not really focused on that. They're about going out, making money, getting new work and getting it done. And they're very focused on the production side of their business and maybe not so much on the boring accounting side of their business. So that's when I, come in and help from a, let's do a cash flow forecast. Let's talk about a budget, let's get things in order in your house so that you can go out and have the infrastructure to take on more work and that sort of thing. Did that cover what you were looking for?
I think so. Yeah. Lori, you have an interesting perspective. Prior to the role that you serve now at Levelset, you were a credit manager for a supplier working directly with construction subcontractors, general contractors, and their purchasing. Can you give us some insight into what you saw in that aspect of your life and how you manage that from a supplier perspective?
Absolutely. So it's always been a big issue. Like you said, I was a credit manager for over 20 years in construction. And obviously we work on the past due accounts. That's our big focus. And typically those are the ones that have the cash flow issues. We found out one of two things was always the case. They either had strong cash flow, but they didn't have any profit, or they had a bad cash flow with a lot of profit. And unfortunately, that usually means that they are making so much, it means that they are not covering their liabilities because their profit margins and earnings are not coming in high enough. It could happen because they're not budgeting for retainage. They may have a high DSO. They're not collecting on their accounts and kind of closing that past due gap. They might not be projecting their cost estimates and progress payment billings. And there's a lot of different ways they can do that, but we definitely find the ones that we were typically working with, they had the bad cash flow because they were just trying to get the profit in there. They may be trying to pay their bills to get that 10% discount or 1% discount within 10 days with some other suppliers. They're just not managing the money like they're supposed to be managing. We had a lot that were trying to pay us in terms, well, they weren't paid yet. So the not paid, pay when paid, not paid, that it has a big effect on contractors, especially, the ones that are working out the back of this truck. They may not have the big office and the other resources that they could use. So managing that cash flow is definitely something that we tried to help them out with.
So question to both of you guys, do you think the average contractor that you work with, I guess in any phase, regardless of the size of their business, do you think they understand cash flow and the management of it and how to use it as an effective tool? I mean, I know they all understand cash flow in my opinion, but I don't know if they understand, and I'm curious of what your thoughts as to what the power of it is when you actually can control it and understand it, what you can do with it. I guess same question to you. What is your opinion on that?
In my opinion, I don't think that they do. I mean, a lot of people start construction businesses, they're the labor side, they don't really know how to do the business side. And then they hope to hire somebody that does have that experience or knowledge, but not understanding the cash flow side of it. I mean, they may get a bunch of jobs and they don't have payroll to pay somebody to work on those jobs. So those jobs just sit out there. They can't grow if they don't have the cash flow coming in to pay the labor, to buy the materials. I mean, it's kind of a vicious cycle. And unfortunately, if they keep getting these jobs and not getting the labor and materials to get out there, they're kind of going to go in more debt. It's kind of that same old sale where it's not a sale until it's paid. I honestly, I just don't think that a lot of them know how to manage that. I know we'll talk later on different policies, but there are ways, that even their credit manager at a supplier can help them. You just got to ask for that help, and they can kind of walk through what's going on in their company currently and try to make some changes on where they see that it could improve.
Suzanne, do you have anything you'd add to that?
Yeah, sure. So we, of course, are issuing tax returns and financial statements. And the first question I get when anybody gets a financial statement is on the cash flow page. And of course, there's a difference between accounting cash flow and perhaps what we're discussing here, cash flow forecasting and things like that. But that's always the first question. They're like, I have more cash than that. I definitely made more cash than that. And they're not sure what's, the inflows are and the outflows are. So it, of course, is a top concern for contractors to understand what that page and all those numbers mean. And so it's really nice to work with them to be able to simplify it and say, okay, here's, cash inflows from receipts of AR and from debt, if you're getting inflows of cash, and then here's your outflows, and, breaking it down and showing them where their cash is coming in and out. I would say our contractors that are maybe a little bit bigger and have an in-house person that has an accounting background are doing a little better in this area. Our smaller contractors that aren't, spending money on the accounting, again, the back room, processing, infrastructure type things, if that's not a focus or priority, then you do see that suffer in their numbers. You see that suffer in their profitability. You see the suffrage in their cash flow. It's pretty obvious which contractors have spent money to pay attention to these things and which ones haven't.
So it's interesting. One of the things I love about doing these webinars is I've watched lots of webinars, and I think that a lot of webinars can point out all the problems, but they never offer any solutions. And one of the focuses that we always have, and what I appreciate about both of you and what you do individually, but also whenever we're working collectively, is you always have a solution. I've talked to many CPAs, accounting firms, or even just CFOs that are either employed by a business, or they're an owner of a business, or sometimes even like your largest fractional CFO organization where they're a CFO for hire. There's one thing that always resonated with me that unanimously they all say is like the first or immediate second thing that they do when they enter in a business is a 13-week cash flow forecast. And anytime I bring that up, you guys are nodding your head, but anytime I bring that up, in a close relationship with one of our clients, probably 80% of the time they say, Scott, what is a 13-week cash flow forecast? They might whisper it to me on the side. And so can you guys, one, tell me if that's also my opinion or my perspective is, do you share that? And two, can you explain what a 13-week cash flow is and why that is the first thing you would do before you do anything else if you were to jump into a business to try to help?
Sure. Lori, were you about to go?
No, go ahead.
So we do fractional CFO work. We have a team for that. So I'm not always the one diving into that specific need, but the reason is, again, back to like, how is this business going to stay afloat? How are they going to stay in business? That's one of the first things we analyze from a risk perspective. As a CPA, we analyze risk. So we're coming in there going, okay, well, is this business going to be able to make it, 3 months or 6 months, what's their long-term sustainability? And, of course, we do a lot of valuation work, and that's one of the ways you value a company is based on their cash flow. So it's one of the most important things for our company to know, even if it's just a basic knowledge of what's coming in and what's coming out, and, what is my forecast for the next, like you said, 13 weeks. So it's just important to understand how the business runs, how do you make money, and what's the viability of you existing past 13 weeks?
Yeah. And I think we're on different sides of it. When I used to work in the credit side, Suzanne, when I worked with the companies, the first thing we did was look at the financial statements, like you said, cash flow page, which usually didn't really exist. But the biggest issue that we always found was that they didn't have a credit policy in place, or they weren't enforcing them when they had. And like you said, the credit policy is what assesses the risk and lets them know what risks they can take and what risks they can't take. So we would work with them, not on the 13 plan thing, but we would work on setting up the credit policy just to, know when they should invoice timely, when they should deal with waivers, contracts in writing. There's just a lot of different specific things that once they're focused on it, it would help that cash flow side a lot better. Yeah.
And to add, what I look at as a cash flow 13, what it really does for a contracting business is when you have receivables of $100,000, $200,000, or $150,000, or you're going to invoice X amount each month. Which the funniest part about the construction world is the business owners in the construction world know an amazing amount of detail about their business. They can tell you who all their customers are, how much is getting invoiced to them, what they're estimated to be invoiced to them. There's a tremendous amount of detail broken down into 3, 4, 5, 6 major categories on a job. It's just never has all the infrastructure been put together to marry up to it. But when it is, those contractors with all the knowledge they have are able to make such a good decision. So to explain to the audience, in my viewpoint, what a 13-week cash flow does for you is it tells you basically where your sources of cash are coming from, when those sources are expected to come, which are inputs that you would provide, and then more importantly, what the cash flow sheet is going to do is then tell you how you can use that cash and when you can use it. You might not be able to use that $100,000 exactly the way you want, but when you look at it over a 13-week period, it gives you a chance to forecast at least 4, 5, 6 weeks in advance, and also look back 4, 5, 6 weeks so you can see exactly what you have going on. So you know when you get this specific $100,000 check in, exactly how you can use that and exactly how much cash you need to leave out of that. So you're not you might be in panic mode one week, but you're not going to be in panic mode every week on every Monday trying to figure it out. It eventually will become a problem that you're solving. You might have panic today, but as that money comes in, if it's used appropriately and it's managed in this way, you will not have a panicked Monday or a panicked month. It'll eventually smooth itself out. That's what it will do for you.
Well, and I think part of that to add is, management of your cash flow, which a lot of people underestimate how much control they may have over the management of the cash flow. So if you're doing a 13-week projection and you can see, hey, I'm going to get paid in this week, but the expenses are due in this week, is there a possibility you could call that vendor and say, hey, I need a 2-week, grace period, this month, because I'm running a little bit behind. Ask. Talk to your, suppliers and your vendors and have open conversations with them. Or, Scott, what you do for a living, look into some, financing alternatives to maybe traditional debt, or, there's a lot of options. And that again goes back to managing your cash flow. So I think it's really important that you not just do the projection, but then you do something with it.
Yeah. No, you're right. And when we decide to make loans, it's exactly what we do. We build out a cash flow forecast for that specific project or groups of projects so we can see where the sources of cash are for when it's needed, and then how we're going to use those sources of cash all the way along. And we use the exact same information that you would put in to a 13-week cash flow for the overall business. So
I was just going to say, I think that's a big deal too. You were saying that you do the cash flow for the job. A lot of issues that contractors are having as well is they may not have enough money for one job, so they take it from another job and put it into that job. So, it just messes it up across the board.
And that's a really bad cycle to get into. It can be very dangerous.
And that's a great segue to my next question for you guys. You guys are so
We
good.
didn't plan that at all.
I don't know how you came up with that, but my question is, obviously you hit the nail on the head. We know that cash flow can impact the performance on a job pretty significantly. What are some of the ways that each of you have seen with your experience and clients on exactly what has happened when cash flow isn't managed? What shows up? What other problems or issues show up?
Well, like I was saying on the jobs, if you can't afford the labor to put out on the job, then you're obviously not going to be able to meet your deadlines. If you can't pay your bills, you may not be able to get the material out there in time for when you need it, especially, right now when it's so far delayed even getting material out there. You see a lot of notices get sent out. You see liens possibly filed. It's kind of your reputation. If you don't have a good cash flow, you're going to unfortunately wind up with a reputation of they can't pay their bills or they can't manage their money. So unfortunately, like I said, I always saw the bad side of it. I never saw the positive side of it. But knowing that jobs have different parts of them, they do change orders, they have progress billings. If you can't manage any of that stuff, it's just going to throw everything up in the air.
I was going to say the same, is that I think it's more long-term than short-term effect. So the long-term effect is you have vendors that will no longer, be your vendor because they're not going to get paid. You have, customers that don't want to work with you because you clearly can't run a, manage your business. So that it's just long-term reputation is the biggest effect that I see, is that if you are especially a new contractor and you want to establish that you know what you're doing and establish yourself in the market as a true player, then you need to have your ducks in a row before you go out, because you will get a bad reputation and people will not want to work with you.
Mm-hmm.
Specific to companies that are trying to grow or are growing, how have you seen cash flow become an obstacle in front of them to grow? So obviously you've pointed out some things related to vendors, if you can't maintain vendor relationships, but a lot of companies sometimes they might have hovered at a good level. They have a good amount of cash, and they get a good feeling, and justifiably so. So they step up and start taking on a different project or a bigger project, and the same offense from a cash flow perspective and management of that cash flow that's always worked for them. What shows up now, and how does that lack of cash flow infrastructure, so to speak, where does that show up as a business is trying to grow?
So I think we haven't, touched on it yet, but construction in most areas of construction, you're going to require bonds. And so there's also this topic we, need to address here is the ability to acquire bonds. So if you do not have a plan, if you don't have financing in place, if you don't have an open credit line, if you don't have 6 months of backlog to cover your expenses, all of these things is going to affect your ability to get bonded. So it's going to affect your ability to get work. So like you mentioned, hey, they're on this job and they're borrowing from this job to do this other job. At some point in time, the bonding company is going to hold their hand up and be like, yeah, we're not bonding you for any more jobs because you're clearly not managing your cash flow, and we don't want to get hit at the end of this train, train wreck. So I think that's a big thing that we haven't really discussed yet, is your ability to be bondable.
Yeah, I would think the bonds is a huge deal as well. But even, some states don't require it, but even getting your licensing or getting your insurance, workers' comp, any of that stuff, if they don't see what they want to see when you submit your application and turn in all your financials and that, you're going to have issues getting all of that stuff. And I think it's on the same line of things, but like if you don't watch your contracts, if you do the pay when paid or the paid if paid, and you're not managing that because, you're kind of shooting yourself in the foot saying that, hey, you don't have to pay me until you get around to it. You're not going to have any of that cash coming in to mess around with. So it's going to affect you a lot.
Yeah. Lori, when you were in the credit markets, and maybe Suzanne, to you as well, have you ever seen the reverse of this, where you have a client who has very aggressive, very organized cash flow management, they have very detailed reports, and with that also came a comfort level for them they know them and they use them, and then they use those as tools to either get credit they otherwise might not have, or get jobs, or other ways. Some ways they've used those tools to get more work or grow or get credit they might not have gotten before. Do you have any stories or proactive things that customers did do with that?
I kind of look at that as our no notice list. We have certain customers, they're big customers or they have great reputations. We just do a lot of work with them. So you just extend all this credit and you don't notice them because you made that agreement with them. And then as a supplier, you run out of all the funds from any of those and you don't have any right to get them back. So I think that they can put themselves out there too far maybe and not have any repercussions for it, because you gave up your lien rights. So there's no like pressure to make them pay on time. To me, it would just kind of throw them off track there.
I do probably have a specific example of a client back in the first downturn of the economy in recent years, back in the 09, 10, area. It seemed like contractors got hit a little bit later. So it might've been in the 11, 12 timeframe that I'm speaking of, but I had a contractor that was very, very tight on cash flow. And they were to the point of like, hey, we may need to like close our doors because we can't make it happen. So we advised them to go look for alternative financing. So we're like, look, just, even if the interest rates are crazy at this point, like you've got to get something, you've got to get anything to, get back on your feet, get something interim, not long-term, but, just something interim to keep them afloat. And they did, they were able to find some short-term financing that was, like a year. It was highly aggressive interest rate. And I don't always suggest that, but it just happened to be, at a pinch point, and it made sense, and it was a good decision. And they made it through. They got the short-term financing. They were able to finish the jobs. They were able to pay their suppliers, and they were able to, keep going. So I think to answer your question is yes, I probably have more than one example of a contractor with that availability to get cash has been able to, continue his business, where if he didn't even have the ability to get that, extra, cash, he wouldn't have been able to take on any more work. So the contractors that are positioning themselves in the market to have some excess cash or the ability to get excess cash are the ones that are able to capitalize on having that available capital to take on jobs. that's part of when you're assessing the risk of, should I take on this work? You have to assess, well, what's my cash flow? Can I take on this additional work? Can I hire these extra people and pay these suppliers to get on site and start doing this work? If you don't have cash available, you may turn down that work. And so cash up front and handy cash, available cash is going to let contractors capitalize and maybe take work that other contractors can't because they don't have financing available or a line of credit or something like that.
I'll add, when I was doing the credit and all that, I had never even heard of like your company funding options that are out there now. I think contractors now have a lot more opportunities to get that cash flow flowing, or at least to get the help for it and to be taught how to deal with it, to where they can take on more jobs, they can pay their bills. I think it's a nice thing to have, not to, sell you here, but what your company does puts a lot of help out there.
Have you guys seen that one? Thank you very much. I appreciate you saying that. But have you seen companies use those financial reports to gain new customers, or maybe win a job that they might not have won before, or in your case, Lori, win credit that you wouldn't have given to them, that they didn't come in and say, hey, look, this is why I need it. I'm running my business like this.
Kind of, sort of, maybe. A lot of our credit was extended based on whatever the job was, not really the customer. I mean, even if the customer has bad cash flow or they don't pay their bills, we always have those lien rights to go on to the GC or then go on to the owner. So not really. It's just whatever the job is. If we determine that it was a good job, then we would fund that.
Mm-hmm. What about you, Suzanne? Do you have clients that come to you? Maybe they ask for a capabilities letter or a financial stamp of approval that they can use sort of in their brag book to kind of win an award, or to show a customer of theirs, an owner, developer, general contractor. Hey, you give me the contract, here's my sort of stamp of approval.
We can't actually issue those.
No, really?
Yeah. So we get asked a lot. We get asked for financial viability, I think was your term that you just used. We're actually precluded from issuing that. That's an opinion that we can't make without doing a formal, valuation of the company and a formal engagement. So we don't actually issue financial viability letters, although I do get asked a lot. What has to stand alone is really your financials, whether they're compiled, reviewed, or audited, or again a formal projection or cash flow analysis or something like that. But we can't just send a letter without doing any subsequent work to support that opinion for our own risk reasons, obviously.
Yeah, no, that makes sense. Well, what we've done at Mobilization Funding early on, I got some advice to always audit our financials. So we do a full financial audit of our financials. And at first it felt like an extra expense, and I couldn't really understand why we were doing it. I mean, I knew why, but it didn't feel like it.
See, you're the typical client, Scott.
Exactly. I tell all of our clients all the time, like, I am exactly the same as you. I've been dragged into all the things I've done. So I'm just now part of helping people drag along, so I can at least say what it feels like on the other side. And what happened, what I realized is when I did, as the business grew and I did need to go get more capital, for which we used to make loans, it was a lot easier when I sat down with an individual with audited financials. And certainly when we went to the bank, who basically thought we were insane.
Bank is like, here.
The bank was like, there's no chance. Why would we ever make loans to you, Scott, so that you can make loans to people we would never make loans to? And, having an audit financials that they could trust and verify, that basically just eliminates their questions off of it. I mean, they're going to have questions, but they're not trying to figure out if you're lying or not, or if you're, that's an extreme word. They don't think you're lying per se, but they don't know if they can trust it. When you have
a third-party assurance,
right.
It's totally reasonable. Their risk is at a certain level, and from our standpoint, bonding companies and banks are some of our obviously biggest referral sources because they need those things to do their work. So it depends on what level they need. So if you need a large line of credit or a large term loan or something, that may require an audit. If it's a smaller line of credit or a smaller term loan, then they may be able to get away with a review or a compilation. And those are 3 different levels of our assurance that we put on that. But the audit is the gold standard, or platinum, that says, hey, we did the most work for this one. And obviously our risk is the highest there as well, because we're opining saying that, yeah, these people, their financial statements are not materially misstated,
It's kind of funny. we assume that everybody has financial statements, but when you're extending credit, 90% of people don't have them. And if you can actually get financial statements from somebody, you actually do award them more credit. You treat them better because they actually, you know that it's put in order. So
well, they're paying attention to their house, back
Yeah.
to the house comment, they're paying attention, they're managing their house and they're getting themselves positioned. And, in this market, it's very hot right now, obviously for transactions. And we notice that a lot in transactions is somebody will get a deal on the table and they haven't had an audit or any sort of assurance from an outside, person. And now all of a sudden they've got caught with their pants down and they're scrambling and rushing, trying to get due diligence work and financials prepared and all of these things. And so, part of that is getting your house in order, having these financial statements ready and the cash flow projections ready, because when someone comes knocking, and right now there's a lot of people knocking, you're going to be like, bam, here's my folder, and I'm ready. So it's just good business.
I mean, one of the things we talk about that, just to your point, Lori and Suzanne, is when we get those financials, we care what they say, but what we really wanted to see first and foremost is, does the company owner care enough to get that monthly scorecard? Like, do you care? If you really care, you want to know how you're doing, and how you're doing as a business is your financials. That's your scorecard in a business world, at least in my opinion.
Absolutely.
And the lack of that certainly can demonstrate to someone, regardless of the size of your business, it demonstrates that it doesn't mean you don't care, but it does mean that you only care to a certain degree. And if you're trying to lend money to someone, or you're looking for someone to lend you money and trust you and care about what your business is and partner with you, it's a really key important thing. And when you're working with your suppliers, they're lending you money. Extending credit is no different than giving you cash. They want you to be paid back. Sure, they have lien rights and sure they have other things, but at the end of the day, they're trying to run a business too, and they're trying to find the right people to partner with. So it is important, and I'm sort of letting people know the little bit of the secrets behind what we do and why we look at
Preach, Scott.
It's important to look at that. But so important. One other thing is cash flow management. One of the key things of that is getting paid on time. And Lori, do you guys have tips at Levelset that you recommend for every contractor to do to basically ensure their timely payments?
Absolutely. So you definitely want to make sure you invoice timely. I mean, that's going to be your biggest thing. With a lot of GCs, they also have specific pay applications that you have to submit. So you want to make sure you understand how and what you're billing for. Otherwise, it's just not even going to matter. You're not going to get paid. You want to protect your lien rights, even on your GC. A lot of people get scared. They won't think that they won't get any more jobs if they send a notice on their GC or something. It is so common in construction. People just, goes in one ear out the other. So protect your rights. You never know what's going to happen. We say to definitely send reminders, if they're not paying in time. Like Susan said, you can call your supplier, ask for a little more leeway on that. Like I mentioned, the contracts, definitely make sure you do not sign any pay when paid or pay if paid contracts. You don't want that risk put on yourself. We also just, sorry, I lost my place there. But no,
I'll pick up to, maybe something you touched on there is, contract negotiation is really big. A lot of contractors feel like their hands are tied and they have no, ability to negotiate their contract. But when you start a relationship with someone new, you need to be very transparent about, hey, this is, these are the deals that I think would be mutually beneficial. Don't just take it. If a GC is saying, hey, this is how we do business, ask, and maybe ultimately they say no, that's fine. But, be very transparent about what your needs are as a subcontractor as well. I think communication is really key. And I know some of those conversations can be very difficult to have, but they're so worth it in the long run.
Absolutely. A lot of those contracts, they'll even throw the indemnification clauses in there. I mean, you definitely want to make sure you're looking through it and make edits, have something, initial it off and just have them make changes.
Redline it.
Yes, most people don't say anything so that,
yeah, no, they don't. They're just like, oh, I better do whatever they tell me. And that's not always true. I think that's a myth.
Yeah.
We actually did a webinar on that topic. We have an attorney that we worked pretty closely with, and they went through, basically, there are 5 or 6 things that you can negotiate in a construction contract as a subcontractor to a general contractor that are just key 3-4 things that are usually pretty negotiable. Most general contractors will accept, but they can make a huge difference when it comes to indemnification, payment, and the key real important things to help you in the event of a disaster or a bad situation, prevent you from being the only person that gets hurt.
Absolutely.
And you can go to that webinar right on our YouTube channel and find that. It is posted, but it's great. They lay out the 5-6 main areas and tell you exactly what you can negotiate. You know, for a couple $100, you can have those sections redlined by an attorney and in the front end, and it will save you tens of thousands of dollars or more on the back end, and give you a little.
Let me add one more thing to that last maybe question is, Lori brought it up, is, you know, friendly reminders to get paid. You know, one of the things we do, which is why I'll tell you, no one likes audits, because we come in and ask a bunch of hard questions that they don't have answers to. And when, you know, you're asking things like, hey, who's your collections person? Do you have a person that's assigned with collections? Do you have someone calling? And they are like, I don't think so. Let me check with my accounting department. And the answer is ultimately no.
Oh, yeah, no, it's amazing how many contractors do not have anybody calling for their payments.
They
You know,
do
they just
not,
kind of
because
hope for it
they
to come in.
feel, yeah, they feel like that would be inappropriate, or
Yeah.
they're too pushy, or they're very scared. You know, they're scared of it. And don't let fear drive your business. You know, that's it should not be driving your business. And so when we ask this question, almost 98% of the time, it's no, we don't have anyone doing collections. Or they'll say, oh, the project manager's in charge of that.
Yeah.
So then we call the project manager and they're like, oh yeah, I don't do that, you know? And so there's nothing wrong with asking for payment, especially if someone is past due, you know? So that's just good, again, good business structure is to have someone that's in charge of paying attention to your collection rate and, you know, calling people and saying, hey, friendly reminder, you're past due 25 days.
Well, and that's how you find out too if your invoice wasn't accepted. You know, maybe you didn't
right,
know
because
that
it may have been declined and you didn't even know it. And that's, you know, part of the, you mentioned also, Lori, was, you know, some people have very specific pay apps that they require to be filled out to the, you know, the decimal in perfection. And if there's one thing wrong with it, or they just don't really like the font it's in, they'll decline it. And so if you don't have somebody following up on those pay apps, your invoice could just be sitting there and you think, oh, they're not paying us because they think our work was crappy, but really they're not paying you because they thought your font was bad. You know, so you need to make those calls and understand why you're not getting paid.
And 2 other things on the contract side of things with the invoicing is you have to watch the billing dates as well. A lot of contractors will have like the 15th cutoff or the 20th cutoff. If you don't get your invoice in before that time, they're going to push it off to the next month.
Yeah.
And then also retainage.
Exactly.
You really got to watch your contracts of when retainage. It's easy to hold it out of your draws. That's fine. But to find out when you're going to get paid retainage, is it when you're done with the job? Is it when the job is totally complete? Is it when somebody buys the property? I mean, you definitely want to make sure, because otherwise that money's just sitting out there and you can't count on it for anything.
Absolutely. Good point.
And you know, if know in reality how many days it actually takes for your business to get paid. Because if you think it's 30 days or that's the terms in your contract, but you're really not, you're 35 or you're 45, planning that has a dramatic impact on your cash flow. And knowing that, and maybe you can't pull your cash flow forward. Maybe your customer is going to pay you in 45, even though you are contracted for 30, but you can make those adjustments and modifications to planning and helping yourself, so you're not in that weekly or daily or monthly stress of cash and managing it. So the other thing I say is be really honest with yourself. Do the work. Don't just look at the terms that you have, but look at what is in reality is actually happening and you are getting paid. Because a lot of times it's net 30 after inspection, and maybe the inspection takes an extra 6 days. So it's really 36 days from when you submitted the invoice. I mean, there's a lot of things, but just be really hone in on that and lock in that real number at that when you're doing your planning.
I can tell you on that same note is there is a lot of contractors out there that won't pay until you call and ask for it, because they get interest on that money as long as they have it.
It's their money. They're using it.
You got to watch that.
Yeah. Well, guys, is there any questions that I should have asked you that I did not?
Maybe not questions, but just a maybe additional comment on, you know, it was maybe a few questions ago, if you have bank covenants or, financial ratios that you need to meet for whatever financing you have, or, for bonding or anything like that. So, paying attention to those before you fail them is always a good policy.
Yeah.
So if you do have cash flow metrics that you need to be aware of, I cannot stress how many times I have met with a client and said, hey, what are your, does your loan have any covenants? And they're like, no, I don't have any. And then I open up their loan document and there's like 7, and I'm like, well, I think you missed this page. So let's go over them. And usually they're cash based, they, and it's debts, service coverage and debt to equity and all these other fun, covenants. And so if you're on this call right now and you haven't looked at your debt covenants, you may want to take a peek at those because they may relate to cash flow. Or when you're closing new financing, make sure that you're asking, what are my covenants? What are my responsibilities to not be in default for this, financing, whatever it is, line of credit, loan, whatever. Good questions to ask. So write them down. A lot of people are just completely unaware of some of their covenants, and cash flow directly ties into them. So another good reason to track it.
Yeah.
And I was going to say, just as far as your suppliers, ask for help if you need it. I mean, I don't know any credit manager out there that wouldn't help somebody that asks for it. We're used to people just not wanting to pay their bills, or they're ignoring you on purpose.
Yep.
Yeah, but if you actually want help, say you have a new GC that has a payout, they will help you, learn how to fill it out, and they'll help you close the gaps on your agings.
Especially if you do good work.
Yes.
Right. Yeah, you don't want to be thrown in a bucket or have someone make an assumption about you because of previous experiences that aren't justified. So it's always good to be honest and upfront with why there is a cash flow concern if there is, so they don't think you're just not trying to pay them.
Mm-hmm.
So, and to the point you made about covenants, actually, Suzanne, I think it's great. Those should become part of the scorecard that you managed yourself to every month. So when you get those financials, get a list of where are you in those debt coverage ratios, those loan covenants, those other items, and know what they are. So you can know ahead of time, so you have a month or 2 to manage to that, versus all of a sudden it's a problem and it's getting exacerbated over the next 2 months. You can start to fix it and adjust it, which is also the reason why accountants don't just do your taxes.
We don't. We're not once a year people,
Yes.
If you have a once a year CPA, start calling around.
Right.
I noticed a question in chat based on our contracts about getting paid when paid. So we're not saying that you can always have that leverage, and you may not always be able to negotiate it. So it sounds like it's not worked for you in the past. And, perhaps that's true. Perhaps the GCs you were working with, or the people you were working with, said, no, that's just not something we negotiate on. That may very well be the case, but that's not the case with everyone.
Mm-hmm.
And also this goes back to the more valuable you make your work and your service, the more apt they are to negotiate with you. So that's just something to consider also, is that if someone new that you're working with, they may say, hey, we don't know these people, we're not really comfortable. But the more work that you do with them and the more comfortable you are with the relationship, you get to the point where you can negotiate those things. So just think of it as maybe it didn't work today, but it might work next year.
Right.
And as you go through, you'll learn which GCs will negotiate on that and which won't, and you just decide if you want to take that job or not.
You decide who you want to work with on the flip side as well.
Yep. And working with an attorney will let you know what the risks are of accepting that clause. So you can then at least make a good business decision whether you want to accept those risks or not.
Exactly.
Awesome. Thanks, guys. I just wanted to jump in real quick and let our participants know that I will be sending a replay of this webinar in an email later today or possibly tomorrow morning. Really just depends on how long it takes YouTube to process the video. Truth.
Blame it on YouTube.
But in that email, I will also include a link to the Ben House webinar, since you guys were talking about
Oh, that'd be great. I haven't actually seen that, so I would love to watch that.
Oh, he's fun. It's a good one. It's
A
long.
fun attorney, are you sure?
I know. Well, that's why we asked him specifically.
Yeah.
And
That's what I always hear too. I'm like, fun CPA, I don't buy it, I don't believe it.
break the mold, Suzanne.
I tried.
I was going to say, you're not your typical CPA, so.
So I always hear that. They're like, you're a what? Are you sure? And I'm like, no, I forgot what I am.
Yeah.
And a link to our cash flow tool and instructions. So that's
Awesome.
to hop in and say all of that will be coming shortly. I don't think we have any other questions in the Q&A. Do you have any last minute questions for Scott, Suzanne, or Lori? Not me, don't ask me questions.
Ask now, will never be available again. I'm just kidding.
Autumn, I think people
all
want
the
to know
time.
what your shirt says.
Oh,
yeah.
My shirt says, I'm the MF.
Love it.
Which I think Lori and Suzanne both have.
I was going to say, when I wore mine, my daughter said it out loud. It was a little awkward.
Yeah, that might be awkward. Yeah, I didn't know. I didn't get the memo on the matching shirt, so I did not wear mine.
Next time, we'll do it next.
Next time.
We don't have any
Well,
in Scott size anyway, so it's fine.
I put one on once, but it wasn't pretty, and you couldn't read it anymore.
That's
Yeah.
funny.
Okay.
Well,
Guys, I really
everyone
appreciate
who
you guys
joined, you have 10 minutes left. Free minutes from us.
Yep,
You're welcome.
3 minutes for
Right.
your day.
10 minutes back to your day. I appreciate you guys joining us.
Absolutely.
All the participants and Lori and Suzanne, thank you guys so much. It's always a pleasure, Autumn. And next time, we'll do it again soon.
Yeah.
Thank
Thanks,
you. I
guys.
appreciate it.
Have a
Thank
great
you.
day.
Everybody.
See you next time.